Okay, now we're going to do question 12 and 13 together. The reason I'm doing them together is because they are interlinked, really. Question 12 is a straightforward question when it comes to depreciation of the asset. Now, there are a variety of ways of depreciating. We haven't necessarily covered all of that. We will do that more in the course. But in our case here, we're just going to do a simple depreciation. We're not again going to estimate it and then reflect upon it. We're just going to take it as a direct cost against our asset. So what we're going to say here, so depreciation is obviously the loss in value of a tangible asset, an actual asset you can touch, feel, you hope you have. In our example here, it's the equipment and furniture. What we're saying is that it depreciated, went down in value by 5%. So what we're going to do is we're simply going to take 5% off the value of the equipment and furniture. And that, so if we have a depreciation account, as I said, we don't need to make a bigger process out of this. We're just assuming that this is absolute end result. Again, depreciation. The classification of this, naturally, of course, it's a cost to the company, but equally we are not paying this out directly. I mean, it's as part of our operation, the operation might have caused it, but it's not, it's what we call a financial charge. Again, remember, the taxes we'll cover shortly, but earnings before interest, which we've done, taxes, depreciation and amortization. Amortization is the depreciative or appreciative effect on intangible assets. So that's why in this instance we're not going to be using amortization, we're just going to use depreciation. It's more straightforward. Methodology is quite similar, so it's not that significant. So again, as I referred to them before as a post-profit cost or a financial charge, depending on how you wish to refer to it. So in our case here, so this is what the depreciation is. It's going to be 5% of the value. I mean, so we therefore know that the depreciation cost to us is 45,000. The loss in value of the asset is 45,000. And that's it. That's literally, I mean, I know there's more to this process, but from a management point of view, this is about as much as you really care about. So this is it. So this is like the end of question 12. We depreciated our furniture and equipment. So the value of our furniture equipment is now 855,000, as opposed to the 900,000 we bought it for. And that brings us to question 13, when we said equipment that had been bought for 10,000 at the start of the year is sold for 9,000 in cash. Now these questions are all done in order so that when a transaction occurs earlier, it will have a knock-on effect for everything that happens later, or in this case, everything that happens later reflects what has happened earlier. So question 13 is reflecting on what happened to question 12. There is depreciation of the asset. So we are saying that equipment and furniture that was bought for 10,000 at the beginning of the year is now sold for 9,000 in cash. 9,000 in cash. Right. Well, let's do the simple things first. I mean, with all of this. Now we know that, well, actually the bank isn't necessarily relevant here. So let's have your cash T account, which is a current asset. We know that we received 9,000, so it's an increase in our cash, or more to the point, an increase in our current assets. So that's the first part. We know that. Now we know somewhere that has got to be 9,000 on the debit, on the credit, and the right-hand side. So we are going to create an account. Somewhere we could technically create a T account that says 9,000. But we still have got this minor difficulty here, that there's a difference in the value. So what we're going to do is we're going to reflect on this. According to question 12, everything was depreciated by 5%. So if I had an asset that was valued at 10,000 at the beginning of the year, I know during the year it lost 5% of its value. Now we have already accounted for that here. So how much is 5%? So we know that this 500 euros that it lost in value is accounted for here already. So we actually don't need to worry about the whole difference here. We've only got 500 euros. But yet, we have 9,000 here. And so we have an asset valued at 9,500 that we sold for 9,000. So this is the first thing, that we depreciated this asset, so it's only worth 9,500. We sold it for 9,000, so we got the 9,000. Now naturally, if this asset is worth 9,500 and we got rid of it, well, that means we don't have it anymore. So we just get rid of it from our books. So there you go, it's gone. So the 9,500 asset is gone. But now we have the difference here. On the debit side, we have 9,000, and on the credit side, we have 9,500. So this is where we know absolutely we need to put 500 somewhere. But the question is, where? Now, before we spoke about extraordinary costs and the fact that they are costs because they're not unexpected, unusual, or whatever the case might be. The example we had used was the sale of furniture from a room or an asset that you're not using any longer, which this is. But the difference is, it isn't the entire sale. An extraordinary cost is actually the difference between the book value and the money that you received. I mean, an extraordinary gain or an extraordinary loss, as the case might be. Naturally, in our case here, if it's valued at 9,500 and we sold it for 9,000, we've made a loss. Which makes sense because this is where we put all of our costs or loss. So what we would do is we would call this, like say, furniture and equipment sale, but it would be, let's put it over here, an extraordinary cost or loss. And that's why it is. But just to summarize again, like when in question 12, when we depreciated the asset, that was we depreciated every single asset. When we depreciated every single asset, it included the 10,000. So that 10,000 is now worth, and by the end of question 12, we had made that 10,000 worth 9,500. We got rid of that asset, so it's gone, it's written off the books. The 9,000 we received in cash. And the difference between it is money we lost. We believed that we were entitled to receive, but we didn't. So we call this an extraordinary loss, because it's not from